Before we move on, Patrick, so this chart that I have here on the screen, I think is quite like it's quite stark, right? Like you could just see the massive amount of and how much the MLI Select program has taken in terms of like units and how many units are coming on, and that's why you're seeing these massive spikes in the rental supply. Now, what do you do as a current real estate investors? We have a ton of real estate investors that own real estate right now. They see this, they're scared. They hear things like, "Oh my God, there might be we might go into like an overbuild situation. Rents are going to crash." How do you defend yourself against this? That's a great question. That's a question the real estate investors should be asking themselves. And the answer from my perspective, Patrick, is you got to keep your unit better than everyone else's. Definitely better than average for sure, and hopefully in the top tier. And if you do that, you'll always be able to compete and you'll always be able to attract. But someone, a local real estate agent here at the, like 20 years ago, gave me great advice. He says, you attract the type of tenant that is a direct reflection of your property. Shitty property, shitty tenant. Good property, good tenant. And you as an investor, that is 100% within your control. Invest in your property, renovate it, change the floors, add some paint, update the kitchen, put some new countertops, update the fixtures. Get rid of those crappy builder grade boob lights that everybody has. Put some nice flush mounts in there. And these are not expensive things, Patrick. $500 here, $1,000 there. You just keep up on top of your property and you're going to be golden. If you let it decay, you will have a decaying tenant along with it.
So you're right 100% on all of what you said. And I want to expand on it a little bit. So, of course, we work and we're talking to real estate investors all of the time. This past weekend, I talked to a number of them, many who've had, they've got 100, 200, 300 doors and are very significant. And they're seeing exactly what we're seeing because that's why they hang out with us. They want those analytics. But I want to expand on what you said. So let's be really clear for investors. Number one, this is not the time to over leverage. I would be really remiss in saying, go in and get a 50-year amortization with the MLI Select if you can still and put 5% down. No, we can't do that. Right now is not the time to over leverage. You need to have liquidity. So if you're going to go and you're going to do that 5% down, 10% down, which probably the math won't work anymore. But the point is, if you did that, just make sure you have liquidity somewhere over there. But to your point, JG, is that yes, you have to have the property look good, feel good, be up to date, all of those things, bells and whistles where you can. But if you're in the markets, especially in those, I'll use Edmonton as an example. Right now, my suggestion would be to make sure you look at the tenants that you have, the good ones that you have, and you reach out. Hey, how are you doing? Get your property manager to do it, or you do it yourself. Doesn't matter. Reach out, say, how's it going? Your lease, I see it's coming due in, let's say, 3 months from now and 90 days from now. What's your thoughts? You've been such a great tenant. How about if we extend the lease and I offer you the same rent? So in other words, be proactive because you know what's coming, and what's coming is going to be downward pressure on those rents. So be proactive, engage with your tenants. If they're great tenants, maybe offer them to keep the rents at the same place, but to actually have conversation with them. So that's, certainly two things. Don't over leverage. Not the time to do that. Make sure that you're reaching out your tenants, being proactive, seeing if there's any issues that you need to look after so that they feel looked after, and then they won't want to move on. So those are a couple other bells and whistles and things to do for investors, because being proactive instead of reactive, you do not want to be chasing a downward wave, JG, because tenants are going to work you over and they're going to go shopping and you're going to lose. Be proactive.
It's a pro tip for sure, Patrick. No doubt about it. And this chart here actually shows, some downward pressure on those rents. That's what you were just talking about, Patrick. And I would corroborate this. And me, I often don't back up the numbers because my numbers are often different. But I'm seeing these numbers in my markets too: the Peterboroughs, the Oshawas, the Barries, the Aurelias, the Lindsays, the sort of golden horseshoe I operate in. I'm seeing this. They're down 5%. Stuff I was getting 2,000 for, 2,100 for. Now I'm getting 1950, 2,000. So they're down 50, 100, 150 bucks, depending on the quality. And you're also having to wait a little bit longer. You're not renting it within 3 days or 4 days or 6 days. You're really pushing to do it in 14 days, 21 days, 25 days. And that's part of the game, but that's why you got to be better. And the good news is, Patrick, is as a real estate investor, people have to understand like this stuff, most of this is within your control. You can do things. We just gave you a list of like 12 things you can do in order to put the odds in your favor. And now it's on you as an investor to go do those things.
So if you like these episodes and you want to learn more about what's going on with real estate in Canada, investing in real estate, and understanding how to invest in real estate the right way, head on down to the descriptions below, follow those links.